Banking can be very overwhelming for entrepreneurs just getting started. But it's important to know the basics before your finances get more complicated. Step 1 is to establish a business bank account. This requires articles of incorporation and a tax ID number. You should also set up online banking, authorize wire transfers, and apply for a business credit card to make sure you have access to money when you need it. As you set all this up, it's important to make sure you're protected from fraud and other security threats.
You want to make sure you have the right security measures in place when you're setting up your bank account. That's something you don't typically think about maybe day one, but as you move down the road and money comes in and out of the account, it's pretty important to make sure you have the right security protocol in place.
Business banking loans are also crucial to get your company up and functioning. Lines of credit allow you to attain short-term working capital to fund accounts receivable and inventory. The life of this kind of loan is typically about 1 year. Monthly interest-only payments are based upon outstanding loan balance. Term loans are used to finance longer-term assets, like the purchase of equipment, other fixed assets, and business acquisitions. They usually have a 3 to 5 year structure. Monthly principal and interest, P&I payments, are required. Commercial real estate mortgage, CREM loans, are used to purchase or refinance commercial real estate or finance new construction. A 5-year term with a 20-year amortization schedule is common. CREM loans also require monthly P&I payments. All forms of small business loans are often personally guaranteed by the owner of the business.
So the loan application process that varies quite a bit. It can be anywhere from 2 weeks to 12 months, and it really depends upon kind of the nature of the loan, the size of the loan. Sometimes if it's a really small loan, those things can get processed pretty quickly. But also a lot of times it has to do with gathering the information. If it's a more kind of risky or complex type of company or transaction, and it requires looking at business forecasts and doing things like that, that can drag out over a number of months.
The bank loan decision criteria is often called the 5 C's: character, capitalization, cash flow, collateral, conditions. What about venture debt? How is it different than traditional bank loans?
So venture debt is specifically related to debt funding for companies that have received venture capital. So they've raised some venture capital and they're looking to put a little piece of debt alongside a round of venture capital that they've raised. You'll find some commercial banks that have technology group expertise and specialties will be involved in venture debt lending. Also, venture debt funds will be involved in venture debt lending. That's a part of the industry that's grown quite a bit over the last number of years.
If you're establishing your first banking relationship, get to know your banker. Your banker can be a trusted advisor for your business and can be especially valuable for a new business. A banker can answer the questions you have and provide knowledge-based information that can help you make better decisions.